This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 323 was recorded on May 12, 2022. I'm Erik Townsend. This episode of MacroVoices was brought to you by FarmTogether.com, where you can hedge against inflation and protect your portfolio by investing in U.S. farmland, now available to all accredited investors. David Rosenberg returns as this week's feature interview guest. Last time we had Rosie on the show, he expressed serious concerns about the stock market and was being ridiculed at that time by his perma-bull peers. Seems he was onto something, and I think you'll really enjoy this update. Then be sure to stay tuned for our Postgame segment when Patrick's chart deck will be titled, When Does the Short-Term Bounce Start?
And I'm Patrick Ceresna. Erik, I was gone for a week, and man, did a shitload of stuff happen in the last 2 weeks. And let's start off before we get into talking the individual markets. Let's talk the higher level macro thesis you've been talking up before we get to that market wrap. What's on your mind?
Patrick, I'd like to review some views which I've held for more than a decade and have discussed at length on MacroVoices over the years, but I think that they really need to be brought back to the forefront because things are starting to happen really quickly. Now, my thesis for more than a decade, and I've been ridiculed for it, quite frankly, has been that I am convinced the real end game starts when inflation starts to run away. I've been ridiculed by people who mistook that statement as if I was saying that inflation was imminent or starting to run away already, something I had never said. I've been very clear that I have no idea when it was going to start. So let me be clear again. I'm not even certain that inflation running away is even starting yet. We haven't seen enough to really conclude that we've got runaway inflation. And there's plenty of people who think that the inflation that we've seen has already peaked and, it's about to be behind us. So I don't know if it's happening yet, but sooner or later it will. The reason I'm convinced that runaway inflation is what will mark the beginning of the end game for U.S. financial markets is that you can literally solve almost any problem when you have a printing press, a central bank attitude that favors liberal stimulus initiatives, and this part is absolutely critical. You also need a deflationary macro backdrop, which assures that there won't be any immediate adverse consequences to all of that central bank supplied economic stimulus that's been so plentiful for the last decade. I've always maintained that there would still be adverse consequences for all that stimulus, but that those adverse consequences would be delayed until the emergence of runaway inflation, which would then cause all of those consequences to hit markets in the face all at once. Once you get runaway inflation, suddenly central bankers' hands are tied, and they are no longer able to make any problem disappear with the magic wand of central bank balance sheet expansion. Now, to be sure, we don't have runaway inflation yet, not even close. The question to ask is whether it's starting or if this truly is a transitory inflation event or a inflationary false alarm, if you will, as many pundits, including guests on this program, have argued. Quite a few of our notable guests have said we've already peaked on inflation, and this is not a runaway situation. I hope they're right, but frankly, I'm getting pretty skeptical. The fact that the Fed finally seems to be afraid of inflation is a good thing, in my opinion. When we get to the real end game, the entire stock market can and should be sacrificed because protecting the bond market and the currency are far more important. And my prediction is eventually something's going to have to give. Now, remember what stock investing is. It's private capital taking risk in search of reward, knowing that they volunteered to take a huge loss if those stocks collapse in value. But what could cause a systemic market-wide equity crash? Well, there's a few things that are starting to catch my eye in the news. I don't know if it's really starting yet, but it sure seems to me like we have some pretty significant indications. The Federal Reserve published a survey on Monday that cited 75% of respondents listing the Ukraine war situation as a serious concern for markets. 68% feared the Fed over-tightening, which is what most of my interview with David Rosenberg will focus on today. But here's one that really caught my eye. 41% of participants cited concern over foreign divestiture of U.S. assets. That's up from never having been mentioned before. In the prior report, there wasn't a lower number that it's up to 41%. Nobody's ever mentioned that before. Now, in my personal opinion, and it's hard to prove this, one of the drivers of that trend is the Biden administration's wholesale abdication of the rule of law. I'm certainly not questioning the degree of atrocities committed by the Russian military, but the way to seize ill-gotten gains is through the aggressive application of the rule of law, not by wholesale abdication of the rule of law in favor of extrajudicial vigilante justice, which in my opinion is what the United States government has resorted to. The world, I believe, is starting to lose faith in the U.S. and its financial system. Now, there's no other immediate choice available, so it doesn't mean that everybody's going to abandon U.S. assets immediately. But I think that this trend bears watching. Now, David Rosenberg will disagree with me in this article. He sees it very differently and says, look, the entire stock market sell-off is a global phenomenon. It's not just in the U.S. My counter to that is, hey, wait a minute. Look at where we were a month or two ago. Patrick, you remember all your chart decks where you were showing, boy, U.S. market's holding up pretty well, but look at the rest of the world really starting to decay. Now, suddenly, we don't have the U.S. holding up better than the rest of the world, and that's happened since the seizure of Russian foreign exchange reserves, which happened extrajudicially by executive decision of the United States government. But wait, there's more. The Fed also said that there was notable deterioration in Treasury market liquidity, and that comes as no surprise as people are beginning to divest U.S. Treasuries. They went on, though. It's not just Treasury liquidity. They also said that there is markedly low market depth in the Treasury market. Now, again, as a refresher, market depth refers to the number of bids below the market, the number of offers above the market. How far does the price move in reaction to really, really big central bank-sized capital flows? When somebody buys $100 billion of treasuries at once and you have a very deep and liquid market, the needle barely moves, even on a really big move like that. As you start to lose depth and liquidity from the market, all of a sudden, capital flows of a large size can dramatically change the price in an instant. That's what we're starting to see, and the Fed has expressed concern about this. Remember, inflation means that their ability not to tighten will be limited. As I said in my book published in 2018, the really big hurdle for a digital currency to eventually displace the U.S. dollar as the world's reserve currency will be for somebody to figure out how to create a global-scale digital sovereign bond market that can match the depth and liquidity characteristics of the U.S. Treasury market. Now, that's been a very high bar to try to compete with. That bar is getting lower, and the technology is evolving quickly. So I wanted to start with this review of things I've all said before, but just to kind of pull it together in terms of the macro thesis, I think it's really, really important to understand whether or not we're seeing the beginning of what could turn into a runaway inflation event, or if this really was a transitory inflation that was a result of supply chain disruptions from the pandemic. I don't pretend to know the answer, but I would certainly caution our listeners that it's time to pay very close attention. And if this inflation does start to run away, it could be a complete game changer.
All right, Erik. Well, let's actually talk markets then. The S&P 500 just gave out those supports in the 4,100 area, and we find ourselves just like an air pocket in the markets, downdrafting lower. I'm going to talk a little bit about it in the post game, but what's your take on this market drop? Do we have more downside to go?
Well, I think market drop is a fair description, but I'm kind of shocked by the number of people who are talking about the stock market crash. Look, there's been no stock market crash. Stock market crashes are a lot more violent than this. This has been a slow motion sell-off. It's not really a crash. I've started getting emails from listeners asking me to stop cracking sarcastic jokes about why is the S&P still over 3,000 and instead give a serious equity market commentary. Folks, I haven't cracked any jokes. I don't understand why the S&P is over 3,000 in this environment. It's not a joke. It's where I think fair value really ought to be. Hard evidence that inflation really has been transitory, has peaked, and is not likely to be a concern going forward would definitely cause me to reverse that view. Thing is, I haven't seen any such evidence. Now, David Rosenberg is going to express a different view in this week's feature interview, so stay tuned for that. I don't want to steal his thunder, so let's revisit equities after the feature interview. But ultimately, the next question on my mind, Patrick, is look, even if this bear market is just getting started, we're already way overdue for at least some kind of counter-trend bounce. So let's dedicate today's postgame segment to that topic.
All right, well, let's move on to the dollar index because that decade level high around 104, which was supposed to be at least a place that the market stalled out, well, that stall out happened for a whole week. And here we have the dollar index breaking to levels that we haven't seen since 2002. What's in store here?
Well, Patrick, I think we are headed higher. As you mentioned, I said last week, expect round number resistance breaking through 104, but I expected to eventually break higher, and I said when we do, it's probably going to be a pretty quick move from there. We kept resisting until today. If this break is sustained, then I say there's still much higher to go. Now, technically, this is not an all-time high because, of course, in technical analysis, when you break out through an all-time high, it's usually an extremely bullish sign. This was not an all-time high, but I think I'm not positive if it was a 20-year high,
20-year high
because my charts don't go back that far. That's what I'm fighting here. It's definitely a high in terms of how far back my charts go in my charting system. Is it 20 years? I'm not quite sure. There's still plenty of room, though. I mean, we've moved so fast, so hard. There's lots of room for corrections. A geopolitical event could change things quickly. But we're seeing, more and more signs of just cracks in the system. The Hong Kong Monetary Authority had to intervene to support the Hong Kong dollar this morning for the first time since 2019. They had to buy 1.6 billion Hong Kong dollars to support the currency. Now, that's not a big deal. They've got plenty of reserves, but it's just another sign that dollar strength is causing ripple effects in the rest of the global economy. What's the next ripple effect going to be, and will it be somebody who doesn't have as much reserves as the Hong Kong Monetary Authority? We'll wait to see what happens. The outcome of this conflict between the superpowers or fourth turning could be loss of dollar hegemony long term. I'm talking 2030 or so. Treasury depth and liquidity red flags cited in this week's Fed survey are the first sign of cracks in that dam, but it's still very early in the story. Now, we actually had Luke Gromen scheduled for last week. He's become a great big TV star now, so he had to reschedule on us, but we've got him booked in early June, so look forward to an update on Luke Gromen's views on the dollar coming up next month. The point to understand here, though, is TINA. There is no viable alternative to the U.S. dollar as global reserve currency. What there is, however, is a growing number of people around the world who are very strongly incentivized to create one. Once that viable alternative to the U.S. dollar emerges, I predict rapid adoption by everyone on Earth except the U.S. government. That could be a recipe for financial crisis worse than 2008 in the United States, but that's still many years away.
All right, Erik. Well, let's talk crude oil. I mean, probably the only market that has relatively been calm. What's going on here in crude?
It's, I have to laugh, Patrick, when you have $5 to $7 daily swings in either direction, and you accurately describe that as calm in comparison to other markets.
Directionless market.
It tells you that something big is going on. Well, crude oil, let's start with inventory. Crude oil built at 8.5. I can't say 8.5 million barrels that way. Okay, let's try it again. Crude oil built 8.5 million barrels. Oh my! I'm trying to cover this the way that all the headlines are covering this headline. Now, if you actually look beyond the headline and realize that 7 million of that 8.5 million barrels came out of the SPR, we really only built 1.5 million barrels, not 8.5, but everybody's focused on that headline number. Most of it came out of the Strategic Petroleum Reserve, and as I've said before, I think it's very reckless and irresponsible to be draining the SPR at a time like this. If we look at the physical market where Cushing, Oklahoma is really short on inventory and needs more, they drew down 587,000 barrels. Gasoline drawing down 3.6 million barrels. Distillates drawing down 913,000 barrels. Net, what that works out to is a drawdown of 3 million barrels, excluding the SPR, which of course resulted in a net build. During restocking season. Now, that's a restocking season during which we haven't done any restocking, and summer driving season is coming up quickly. Meanwhile, U.S. production fell 100,000 barrels down to 11.8 million barrels, coming off a plateau that lasted quite a few weeks there. What's wrong with our oil industry? I mean, these guys are acting as if the President of the United States was doing everything possible to sabotage their success and vilify the very people who are actually keeping oil prices down and making them enemies of the people. Oh, yeah, that's happening. Never mind, scratch that one. Let's move on. I still say much higher prices are to come, even without a further war escalation. But wait, there's even more. The NOPEC bill was passed by the U.S. Senate during the course of the last week. It would apply U.S. antitrust laws to foreign sovereign nations. Okay, I think we've got a definitional issue here with the concept of sovereignty. We're applying U.S. laws and saying that actions taken by other nations on their soil are in violation of U.S. law outside of U.S. jurisdiction, but we're the United States and we have the biggest military, so we're going to enforce our laws on you anyway. Does anybody remember the rule of law? This legislation is being introduced at a time when key partners like Saudi Arabia are already being forced to reevaluate long-term alliances. OPEC ministers have begun warning of a 200 to 300% increase in oil prices if this is actually passed and implemented. Now, I'm sure they're exaggerating a little bit because they're trying to make a point, but these are people who I don't think the United States should be pissing off, particularly not through the wholesale abdication of the rule of law, which I find to be extremely embarrassing. Bottom line, my opinion, enjoy the low gas and diesel prices that you currently have at the pump. I don't think they're going to last. Long term, I think they're going up and going up a lot, and it's primarily because of failed policy. Short to intermediate term, though, if this stock market sell-off continues and it really does become a crash, there's plenty of room for a big dip in oil prices, down to $80 a barrel, maybe even lower, when the consensus wakes up to the reality that the Fed is intentionally trying to engineer an economic recession, and I think will soon succeed. But I think that will be short-lived. What will happen is the speculative long interest will come out. That'll put the price down considerably. It has to. And then supply and demand reality will take hold again, and we'll be back up to current prices. And finally, I think the European Union is going to face a serious liquefied natural gas challenge come autumn, and that's going to result in even more challenges.
All right, Erik, let's get to gold because gold and silver really just have been incredibly weak. This is just an environment where the U.S. dollar higher is just the dominant trend, and all these risk assets, including gold, have just been so weak. What's on your mind here?
Well, as you were speaking, I had to scroll my gold chart because the price had moved off the bottom of the page since we first started recording our market wrap segment. Ola Hansen had a chart that showed where a long-term support line was, and it was around 1830, low 1830s. And of course, the theory of these technical analysis support lines is it ought to hold, but if it doesn't hold, especially if you get a daily close below it, it potentially brings on an acceleration of downside selling from there. So right now I'm looking at 1822 on the June delivery contract for COMEX Gold, and that's definitely below Ola's number. If we close below there and stay below there for a couple of days, it could mean that we're headed much lower. Now, I haven't given up yet, but the fact remains that precious metals have underperformed versus other inflation hedges. David Rosenberg has a more optimistic view, so stay tuned for that.
All right, and let's wrap up with touching on the 10-year Treasury yield, which is back down below 3%. What's your thinking here?
Well, that's the key, is what you just said, back below 3%. Last week I said, okay, look, if we get a sustained break above 3% on the 10-year and it holds, that's cause for alarm. And, of course, when we recorded last week's show, we were breaking out to 3.20 or something on the 10-year. Now we're back down to 285. So it's not holding, at least for now. If we do see a sustained move back over 3%, then I would say put your seatbelt on and get some popcorn ready, because it's going to get really scary from there. Looks like for now we're coming back below it. Maybe it really has peaked. We'll see what happens.
Well, this week's feature interview guest is market legend David Rosenberg. Erik, why did we get Rosie back on the show this week?
Well, I think the mistake everybody makes when analyzing financial markets and listening to experts is they tend to favor the most eloquent, well-spoken guy. I tend to favor the guy who got it right before everybody else saw it. And in this case, although David Rosenberg is definitely eloquent and well-spoken, he definitely saw this coming before the rest of the market. Last time we had him on the show, everybody else was just talking about buying the dip, and Rosie was fairly emphatic, saying, no, I think the game is changing, and I think we're heading lower. So he got the call right, and what I want to find out is it over now? Is everything he was expecting in terms of downside already been cooked into the market, or are we headed much lower, as I've been predicting for more than a month now on MacroVoices? Let's find out.
Well, Erik's interview with David Rosenberg is coming up as MacroVoices continues right after this message from our sponsor.
With inflation reaching a 40-year high, investors are looking toward real assets to help safeguard their portfolio. One asset is rising in popularity. Farmland has consistently provided returns more than double the inflation rate since before 1992. How? Because farmland's value is underpinned by its critical role in the global economy. The country's growing population needs to eat. Farmland is well positioned to maintain its value over time, no matter the economic condition. As the supply of arable land in the United States shrinks each year, high-quality farmland should only become that much more valuable in the long run. Interested in adding farmland to your portfolio? Head to farmtogether.com. Farm Together is tapping into the nearly $3 trillion U.S. farmland market to bring unparalleled access to institutional quality farmland through a variety of products, including crowd-funded farmland offerings, 1031 exchange, sole ownership bespoke offerings, and most recently, the Sustainable Farmland Fund. Check out farmtogether.com today. You'll be glad you did.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Rosenberg Research founder David Rosenberg. Last time we had Rosie on the show, he was a bear in a room full of perma-bulls. David, I think there was something to what you told us, that maybe stocks don't just go up all the time after all. Give us the rundown here. What's going on? Why is it happening? How come other people didn't see it as early as you did? And what do you think is coming next? Is this over? We just had David Tepper, and I should let our listeners know we're speaking on Tuesday morning since the market is moving very quickly. From our perspective, market has been falling. We're looking at about 39.60 on the S&P right now. David Tepper covered his shorts that caused the market to rally dramatically for all of about a half an hour and back down again this morning. What's going on? Where's this headed, and how much further down do we have to go?
Well, back to your initial comment about, what is it that the bulls didn't see at the turn, was they just didn't take their own advice. Because, through the previous 2 years of what was a parabolic move in the stock market, the mantra was, don't fight the Fed. But you see, that works in both directions. And so what's wrong about the bulls staying longer in the game than they should have was that they're fighting the Fed in the other direction. The Fed is, if you're a long-only investor, the Fed isn't your friend anymore. At some point, they will become your friend. The point I was making all along was that, the 4,800, call it peak on the S&P 500, at the start of the year was a real fictitious peak. we had no business being there. And so what's happened these past 3 years? 3 years in a row of unremittent policy easing by the Federal Reserve. 2019, the Powell pivot, cut rates 3 times, re-expands the balance sheet after telling everybody in 2018 how he was going to move the funds rate above neutral, never came within 50 basis points of that, and the Fed was going to shrink the balance sheet, but they did the opposite in 2019. And then in 2020, of course, we have the pandemic and the lockdowns, and we get double-barreled rate cuts and then unprecedented balance sheet expansion. We take rates to zero. So in 2021, the easing by the Fed wasn't about interest rates. It was about ongoing balance sheet expansion, which continued to stimulate the animal spirits in the stock market. You can't go back in history and find too many times when, for 3 consecutive years, the Fed was continuously easing monetary policy. And so you see what happened was when you look at the stock market, it's the product of two numbers, earnings and the multiple that investors are slapping on those earnings. And that gives you the S&P 500 price. So you see what happened was that from the end of 2018 to the end of 2021, the S&P 500 practically doubled in a 3-year span, which hardly ever happens. It happens usually at bubble peaks like back in 2000. And when you do the arithmetic, 70% of this 3-year bull market, that of course included the bounce off the March 2020 lows, but 70% of the 3-year bull was multiple expansion. Only 30% was earnings growth. I'm not going to tell you that earnings weren't good, but earnings were really the two-bit player in this equation. In a normal bull market, the main actor is earnings growth. Earnings are 70% of the driver for valuations, and the multiple is the other 30%. And we reverse that in that 3-year period from the end of 2018 to the end of 2021. So, the Lord giveth and the Lord taketh away. And so when you have really a multiple-led bull market that is being predicated on Fed policy tailwinds, you have to know that when those tailwinds become headwinds, that 70-30 split between multiple and earnings are going to switch chairs at the table. So I was just saying naturally that if we get that mean reversion of really what a true driver of the market is, which is not predominantly multiples, but predominantly earnings, we're going to get to 3,600. And we're on our way to 3,600. I'm just not convinced we'll necessarily stop there. But that's just the arithmetic of what a normal market would have taken the S&P at the peak. We had no business being at 4,800. And now we're paying the price for the fact that the driver of it, which was Fed policy, that movie is now rewinding in the other direction. And that's the story.
David, I couldn't possibly agree more with your analysis, but I want to play devil's advocate here because what the detractors would say is, look, okay, you got the call right. It is about Fed policy changing, and they're at least making noises about how they're going to normalize their balance sheet and tighten policy. But look, we all know the Fed put is in place. Just any day now, they're going to come to the rescue. They're going to save the market because they always do. And as I told our listeners earlier in today's episode, I think the game changer here is if inflation starts to run away, and we're not quite there yet, but we're getting close, that really ties the Fed's hands. They won't be able to provide all of that stimulus and liquidity. Am I right about that? And is that a risk yet, or are we not really there yet?
Well, I think that this is a different Fed in the respect as to what you said. We have 8.5% inflation. Of course, that number is going to change and probably has peaked out. But remember that their target is 2. The Fed is feeling that its credibility is being jeopardized, and they're panicking. So you can't compare this to previous Feds where if the market was down 20%, they'd be there to hold your hand and pick up the pieces. It's not going to happen this time around that easily because they are fighting an inflation battle that we haven't seen in 4 decades. Now, look, Powell has had lots of opportunity to do exactly as you said, to say, okay, enough is enough. We've already had, the S&P, say, is down 17, 18%, but you've got The NASDAQ's down closer to 30%, and the Russell's in a bear market. And you have wide swaths of the economic sensitive stocks. Yeah, so you've got a market that's not in a classic bear market only because utilities and consumer staples, the two sectors you want to own in a recession, have hung in so remarkably well. But when you're taking a look at the home building stocks and the home furnishing stocks and the banks and the retailers and machinery stocks and the truckers and the rails, they're basically telling you that this is a bear market. It's a bear market in the economic sensitive stocks, which is a lot of information. It's just not a bear market in the stocks that do well in a recession, which is information right there. Look, back in early March at the semi-annual congressional testimony, in a conversation that Powell's having with Senator Shelby from Alabama, he is comparing himself. I'm talking about Powell's comparing himself to Paul Volcker. He didn't compare himself to Arthur Burns, didn't compare himself to William Miller, didn't compare himself to Alan Greenspan or Ben Bernanke. Compared himself to Paul Volcker. So if you want to find out what the Paul Volcker put was, it was an 8 multiple on the S&P 500 in August of 1982, in case you're wondering what that means. He's comparing himself now to Paul Volcker because Paul Volcker is revered for being the inflation dragon killer, but he killed the economy to do it. And he had to do that because we had a massive series of supply shocks from OPEC. Now we have global supply shocks from a wider array of sources beyond just energy, including China's aggressive COVID policy and, of course, the Putin war in the Ukraine. These are complicating factors that have taken the aggregate supply curve increasingly to the left, and that is inflationary from a cost push perspective. And the Fed in the past several months has said enough is enough. So I don't know what there is more to be said. The Fed has laid down the gauntlet. We have a situation where they're talking about 75 basis points. You have people criticizing the Fed for taking 75 basis points off the table, which Powell really didn't do, but he just said that they weren't discussing 75 right now. But we moved to a situation where now it's commonplace. Now 50 basis points is supposedly a walk around the park. Who doesn't know the Fed's going to go 50, 50, 50, then 50? When was the last time the Fed went 50 basis points 3 meetings in a row? This is serious. This is significant tightening in monetary policy we're talking about. You have people saying they should go 75. They're going to actually, if it's going to be Paul Volcker, just understand, Paul Volcker killed inflation. But he killed the economy in back-to-back recessions. And in those recessions where he killed inflation, and he was successful, and he's revered, there's plaques and monuments and statues for Paul Volcker. He had to kill aggregate demand. And he had to actually kill the stock market. And paved the way for a secular bull market in the process, but you didn't want to stand there catching daggers from the sky as the process of killing inflation by killing aggregate demand from a cost push inflation process. You don't want to participate on that from the long side if you don't have to. And that's really, I think, what the story is right now. The Fed is fighting inflation into a very weak economy, a wobbly stock market, liquidity problems everywhere, and credit spreads now are widening sharply, and we're staring a recession in the face. We are staring a recession in the face. And the Fed's not even done tightening yet. But if you're going to ask me, how low can this go? I said before, we really should be at 3,600. I know that sounds, people just shudder when they hear that because we were 40. We never should have been at 4,800. But we come down to fear and to greed. I don't think 3,600 will necessarily be the stopping point. As awful as that sounds, going down another 20%, then you're talking going down another 25 to 30%. But yes, I think that, you see, the problem all along was the starting point. The problem all along was the starting point on the multiple, just as it was back in the opening months of 2000, when the problem was the starting point on the multiple. And that bubble peak in the NASDAQ, and it affected all the major averages at the time, but that was the poster child for the bubble. Well, we also came into this turn in the cycle in a bubble. And I'm not going to say it was as big a bubble as the dot-coms, but it was a very significant price bubble where I said before, earnings fundamentals, despite what you're reading, you hear, earnings fundamentals were solid, but not that solid to generate 4,800 on the S&P. That was because of TINA. There is no alternative. And it was because of FOMO, fear of missing out, and it was because the Fed has your back. All that has changed. And so when I'm taking a look at, the Fed is telling everybody we have to weaken aggregate demand. Well, aggregate demand is what drives corporate profits. That's ultimately what you pay for. We haven't even seen, you see, everything I'm talking about, everything that's happened this year has been contracting the multiple, getting the multiple down to more appropriate levels. We're not even there yet. We haven't even seen the recessionary impact on earnings. That's going to come next. And that's how you get to 3,100 on the S&P. It's going to hurt a lot of people because they are invested passively in ETFs, the easy route. But there's quite a bit of pain ahead. The Fed is only focused on one thing right now. It is not about assets. They are focused on getting demand weak enough to get inflation back down to 2%. And the sooner the better. So that's what they're focused on right now. They actually need, do you understand what I'm saying? They need a bear market in equities. They need home prices to go down. They need all that. They need asset deflation to play a role in getting the consumer inflation back down to where they want it. They need that. They talk about the need for tightening financial conditions, which is just a nice grandmotherly way of saying, we need a bear market. Tightening financial conditions means two things: a lower S&P 500 and wider credit spreads. The question is, what is the financial conditions that will finally get the Fed what it wants? 2% inflation, and we've modeled that out. We have modeled that out, that for the Fed to get to 2% inflation, for everybody saying we need to get to 2% inflation, it's going to take a lot of hard work on the demand side of the economy, unless somehow Beijing changes its policies or Putin withdraws. These global supply chains aren't going away, and their impact on the inflation that has the Fed so concerned. That means we're going to 3,100 on the S&P, and it means that high yield spreads go from roughly 400 basis points today to 700 basis points. So my advice is be patient and be disciplined, stay calm, and have cash on hand to put to work when we get to those levels in equities and in credit.
David, I was particularly interested in your comments about Jay Powell talking so much about how he seems to be channeling Paul Volcker, like he's going to be the new Paul Volcker. Well, hang on a second. Something that Paul Volcker said before he died was that the approach he took in the early 80s to defeat inflation would never work today because we have a completely different debt situation than we had at that time. So the guy who won all those plaques and statues and awards said it's not going to work this time, but it seems like the guy who's running the Fed is trying to copy something that the guy who succeeded last time said wouldn't work again. Am I missing something?
Well, he's only saying that we're not going to, 20% interest rates. And of course, what's very interesting is that the natural rate of interest continues to go down. And the Fed even cut its estimate of the neutral or natural rate of interest at its last time it put out its dot plots from 2.5% down to 2.4. The neutral rate of interest was a lot higher in Volcker's day because of the debt situation, which is far less a constraint than it is today, and you're 100% right on that. But also we had a more vibrant, younger demographic profile back then as well. And technology was only 1%, sub 1% of the economy. Today it's 7% of the economy. So we have much more disruptive technology today. There's a lot of structural factors in the economy that has taken the neutral interest rate down over time. That explains why we've been in a secular decline in nominal interest rates for such an extended period of time. A lot of that is demographics, by the way. As I said before, that's very important, the aging demographics, just like you have in Japan and in China and in Europe. But also the debt situation is a critical constraint. So all Volcker was saying is that under those constraints, we would never be able to get to 20% interest rates. what I'm saying is that 4% today is going to feel like what 20% did, back in the early 1980s. It's just about the level of interest rates that we peak out at. We're going to peak out at a relatively low funds rate compared to the past, as we already have done over the course of the past 40 years. The peak in the funds rate in every cycle is getting lower and lower and lower because of the factors that you cited, or one of them, which was the excess of debt. But that sort of camouflages the overriding point here, which is that the Fed is not going to stop until something seriously breaks. Now, what I'm saying is that we would have to have a real cataclysmic, destabilizing decline in the stock market, or something dysfunctional happening in the corporate bond market for this so-called Powell put to come back into vogue. Something very nefarious is going to have to happen. And, for example, when you're talking about how that happened in 2018 in December, it wasn't so much about the stock market going down almost 20%. The corporate bond market froze up. There's no liquidity. We went almost 2 months without a single high-yield bond issue. So I'm not saying that they won't respond to financial market conditions, especially if they become disorderly and destabilizing. They will respond. Then again, we're not there yet. This has been an orderly onset of a bear market. If it becomes really disorderly, the Fed will have to respond. But once again, knowing that there's some non-trivial prospect that could happen, do you want to really participate in that? And then on the other side of it is that the most important thing is, when he's comparing himself to Volcker, is acknowledging that no matter the fact that we could be staring recession in the face, demand is still too strong relative to supply. Therefore, we have to weaken demand that much more to get inflation down. And that's really what the story is. The Fed is not tightening into a booming economy. This isn't the 1990s or 2000s. This isn't a booming economy. GDP is actually, people don't realize there is a monthly GDP series. And between October and March, real GDP is running negative 2.4% at an annual rate. I don't think people realize that in real terms. And remember that recessions and expansions are defined by physical units of spending and income. It's not about nominal. Nominal GDP never went negative once in the 1970s. Nominal didn't go. Yeah, we had 3 recessions in 1970, 73, 75, 1980. Everybody talks about nominal GDP. I think that, we had commentators on television last week, I won't say who they were, talking about, don't worry, nominal GDP is doing just fine. Yeah, because of inflation. But inflation is also corrosive, and the Fed realizes that. But it's eroding real GDP. And real consumer spending, by the way, has been flat between October and March. I don't think people realize how weak the economy is. And yet the Fed is not just tightening, whether it's 50 or 75, they're not in 25 basis point camp anymore. They're getting super duper aggressive here. So that is a sign to me that this particular Fed, like the Volcker Fed, is going to be willing to sacrifice the economy. The economy will be the sacrificial lamb, as it was Paul Volcker to do one thing, which is to kill the inflation.
David, you said earlier that the Fed really needs a bear market here. They're just not going to come out and say it. Would you take that so far as to say the Fed really needs to engineer an economic recession in order to fight inflation? And, of course, they're not going to say that for political reasons, but that really is what they're doing. Is that right? Am I interpreting your...
that's exactly what I just said. Both things.
Okay, just wanted to make sure. You think that they are engineering a recession on purpose?
I think the recession's starting right now. I don't even think you have people out there saying it's not till 2023. I just roll my eyes at that. It's staring us in the face. It's in the markets, and it's actually in the data. But you just have an industry of people, don't you see? These sell-side economists, their career longevity is at stake. Well, that's why I started my business, was so I can get away and just not have compliance and not have directors of research tell me what I'm supposed to say to make people feel good. If I wanted to make people feel good, I would have called my company Rosenberg Circus instead of Rosenberg Research. It's really basically to help people stay out of trouble. Now, if you're a buy and hold, long only investor, I'm just going to buy and hold for 20, 30 years, I don't care about the cycle, then fine, just do that. I'm not your guy. But if you actually do like to invest around the cycle, if you don't like to participate in bear markets, then I am someone that you want to listen to. Whether I'm right or wrong, I have a thought process. And what I'm saying is that 100% as to what you just said. They compared himself to Powell, telling you we are willing to sacrifice the economy for the greater good. Short-term pain for long-term gain. We are going to kill inflation. The Fed can't kill inflation. It doesn't know how to grow wheat. It doesn't know how to build a semiconductor factory. It doesn't know how to convince Xi Jinping to lighten up on the zero COVID policy. I don't think Jay Powell has a relationship with Vladimir Putin. Anything the Fed can do to combat inflation is through the demand side. Now, if we were talking about an economy growing at 4, 5, 6% growth, I'd say, hey, they have a lot of run room, a lot of cushion to slow things down to get inflation down. We don't. The economy actually contracted in the first quarter, and I don't think we're seeing any growth in the second quarter. Pending home sales, which is the gold standard for the leading indicators for housing, is rolled over 4 months in a row, negative 8% year over year. Housing is going into a recession. Is that a big surprise looking at what mortgage rates have done? The consumer, even with all those savings, you see the consensus says, don't worry about the consumer. They're sitting on $2 trillion of excess savings on their balance sheet. But what's the assumption? That in a recession, they're going to spend that money? Because in a recession, people get nervous. And so that excess savings is just going to stay as excess savings. And then when you're taking a look at the leading indicators for capital spending, companies now are going to be hunkering down. And all the while, the Fed is raising rates. Interest rates matter for a leveraged economy and a credit-driven economy like the United States. And on top of that, we have a surging dollar, which, by the way, is going to look after imported inflation. Make no mistake about that in the coming year. But look what the dollar's doing. And the stock market is telling you exactly what I'm saying right now, because the sectors that are declining the most are the most economic sensitive sectors of the market. You'll say, well, bond yields haven't moved. Bond yields have actually gone up. Yes, but take a look at what's happened here. That in the past 2 months, it's hard to believe that 2 months ago, the 10-year Treasury note yield was like 1.6%. I mean, it's almost doubled in a 2-month span, unheard of. But you see, what's interesting is that inflation expectations haven't moved. What's moved is the real interest rate in the bond market and the term premium, because that's what the Fed has moved. Everything that's happened in the bond market, despite all the narrative, has not been about inflation. It's not been about inflation. In fact, if you want to see about inflation, draw yourself the chart of copper. It's broken down. And the basic material stocks, which is the poster child for inflation in the stock market, is in a correction mode. I have to tell these to people because they don't want to believe me. They just believe that we're in a new area of, we're in a whole new paradigm of inflation. The inflation indicators are starting to roll over. And that's why I do think this Fed tightening cycle will end up being truncated. But as we've seen in the past, the Fed has this natural tendency to overdo it on the easing cycles, as they just did, and overdoing it on the tightening cycles. Which they did in 2018, and which they did back in 2005, 2006. Before that, 1999, 2000. It's why we have cycles. We have the Fed to create these cycles. We've had 14 Fed rate hiking cycles in the post-World War II period since 1950. 11 landed the economy in recession, and it's not a pure coincidence. So I'm saying that we have an over 80% chance of recession if you look at the historical record. But actually, I'm being very conservative when I say that, because I can see it staring me in the face. And the Fed is willing to do that. The Fed, when he compares himself to Volcker, it is code for, I'm going to sanction a contraction in aggregate demand to get inflation under control. And so when you go and take a look historically, in recessions, the stock market, and this is just an average with a wide dispersion, is down 30%. Now, some sectors have done a lot of heavy lifting, but the overall market is not down 30%. And as I said before, the ultimate decline, considering the starting point of the bubble. And we were in a price bubble at 4,800. We were in a price bubble. And as they say, the higher they are, the harder they fall. That was a spectacular case back in 2000. It's less spectacular this time, but still it means that the lows in the market are far out there and far below where we are today. People don't want to hear that. That's fine. You don't want to part with your beloved portfolio. You fall in love with your equity portfolio. Well, I would suggest then, sell call options against them and buy some insurance policy against what is likely to be a few further down legs to this story.
So far, we've been talking about the domestic economy, the reasons that I think we agree that the Fed almost needs to engineer a recession on purpose in order to fight inflation. But I was really interested by the Fed's survey published Monday of this week. It did say 68% of respondents feared the Fed over-tightening, which is what we've been talking about, but 75% cited the Ukraine war, and what really got my attention was 41% of participants cited concern over foreign divestiture of U.S. dollar-denominated investment assets. That's a category that didn't even exist in the previous report. There was no mention of it, and all of a sudden 41% are concerned about foreign divestiture of U.S. assets. Is that part of what's driving this equity market sell-off?
Well, I don't know why it would be, because the U.S. isn't alone on the bear market in equities. It's a global bear market in equities. So this is not a U.S.-centric story. Emerging markets are way down. Asia's way down. Europe's way down. So to pin this on some loss of confidence in U.S. assets makes no sense to me whatsoever. You had this concern that there'll be a payback from the U.S. freezing central bank reserves by Russia, and talk of how the Saudis will be pricing oil in renminbi. So I've heard all these stories for so many years. I remember that when the Euro's IPO back in 1999 was 1.18. Where are we today? Like 1.05, and all you heard about was the new kid in the block is going to replace the U.S. dollar. No, sorry. What's very interesting in this, that despite all the talk of the loss of confidence in U.S. assets, and maybe that's how Americans feel, but it can't be how foreigners feel, because somebody out there is driving the U.S. dollar up to 20-year highs. The U.S. dollar, I'm pretty sure, is about the only currency in the world that's up 12% on a year-over-year basis. I will grant you that even sterling, which has lost that reputation, is definitely not up 12% year over year. The U.S. dollar is. So my temptation might be just to fade that survey altogether.
Let's move on to precious metals, a subject near and dear to many of our listeners' hearts. And boy, not performing very well at all in this environment. In many ways, we've got the inflation that everybody feared. It doesn't seem to be driving precious metals prices any higher.
Well, again, this is a case of, beauty being in the eye of the beholder. Because I'll tell you right now, if I drew you the chart of the yen price of gold, the sterling price of gold, and the euro price of gold, you'd be impressed. They're at near record highs. It's just been, so people look at gold and make their assumption that gold is doing poorly. But no, it's actually it's been a broadly based run up in the US dollar, because in these periods of rising rates, liquidity starts to become an issue. And there's nothing more liquid than the US dollar. And so the US dollar's gone up against everything. I mean, look what it's done against the Canadian dollar. The Canadian dollar is supposed to be a petro currency. It's been slip sliding away. The Australian dollar and the New Zealand dollar are the poster children for inflation. Aren't we supposedly in a big inflation cycle? I'm told we're in a whole new era. Well, if we're in a whole new era of inflation, and people on the line believe that, you really have to answer, why is it then that somebody in the investment community is taking the Australian and New Zealand dollars lower? That's not normal in a new paradigm inflation environment. The US dollar has gone up because of liquidity concerns. And gold looks like most other currencies, except for the fact that it's actually outperformed the three major currencies. I'll just tell you right now, year to date, year to date, if you're looking against the yen, sterling, or the euro, gold is up more than 10%. And you know what's very interesting is that when I mention this to people, the first question back is, can you send me the charts? Sure, I'd love to. So gold, I'm nervous about gold when it is a broadly based decline in all currencies. I get worried about gold. But this is a US dollar story, and it's a very overcrowded trade. So gold is held in extremely well against all other currencies, and I would say that at some point the Fed will cease and desist. We'll have a nice interest rate rally in terms of yields coming back down. The US dollar will come down, and gold will break out again. So don't give up on gold. This is a US dollar story. It's not a gold story.
Let's move on to interest rates. Obviously, with the Fed fighting inflation, the way to do that is to raise interest rates. How much farther can this go? Where do you see the 10-year yield headed from here?
Well, look, the markets are giving us a lot of good information. We may have peaked already. And now, lo and behold, we're back below 3% on the 10-year. Not that I ever thought we'd see us above 3%, but we got there. But, markets have this nasty habit of overshooting and undershooting in both directions. You have a lot of inflation, and you have a lot of Fed already priced in to the long end of the U.S. yield curve. I think it actually, offers some value here. And especially, you can pick up a dividend yield on the S&P of 1.5%. Or you can buy the 10-year note at 3%, even more at the long end of the curve. So the one thing, as I said before, is at least with this backup in yields, we could take the N out of TINA, that indeed there is an alternative. I think that the Fed, the Fed is doing everything it can to enhance its credibility. It's come under attack from the markets, from the media, from Congress. Even the White House has pressured the Fed, not in the way that Trump did. Trump wanted the Fed to lower rates. Biden is, campaigning aggressively against inflation. It's like public enemy number one. So I guess we're going to replace an inflation shock with an interest rate shock. I'm of the view, by the way, everything I said before, I think it was unnecessary for Powell to turn as hawkish as he did. I think it was not that the Fed shouldn't have raised interest rates, and I'd be the first to tell you that when Biden came out with that budget buster in March of last year, the Fed should have stopped QE. There's no reason why the Bank of Canada would have stopped QE like 4 or 5 months before the Fed did. The Fed kept on easing policy and buying mortgage-backed securities, so adding stimulus to housing as the housing market was going on steroids. I do blame the Fed for that. I blame the Fed for ongoing QE last year. I think raising rates off of zero makes perfect sense, but I think now they've just gone, Dr. Jekyll and Mr. Hyde. And now, does anybody in the line believe that even 3 months ago we'd be having debates whether they should go 50 or 75? Whoa, we've come a long way. I think this economy is very fragile. I have a lot of data and a lot of modeling telling me that inflation is going to come down significantly in the next year. And as would have been the case, even if Volcker didn't kill the economy, inflation would have come down. Maybe not quite as fast. It's amazing what happens to inflation when you kill demand. Inflation falls pretty fast. But I think that, it's already too late. The impact of both rates, and the Fed certainly is committed to 50 basis points. They mentioned at the next two meetings, they're going to go 50 at the next meeting, which is 5 weeks from now. As they say in French, les jeux sont faits. I think that the gig is up. And then you've got this tightening. The U.S. export sector is $2.5 trillion. The economists say, don't include the exports, forget exports. Outside of exports, the economy is doing fine. It's a $2.5 trillion support for the U.S. economy. And it's all domestic production. But we're told by the intelligentsia to, don't focus on exports, which are going to get crushed by the lagged impact of the stronger dollar. So we have a lot of tightening already in the system. I could see the Fed, to tell you the truth, this is why I say stick with gold, because I could see that the Fed probably is going to move rates despite the bravado. I think they move rates one more time. I think they're going to have the capacity to move rates one more time before things roll over and start to get ugly. And I think they'll go on hold. I don't think they're going to hold your hand as an investor in the equity market and say, we're cutting rates again. That's definitely not happening. But they'll stop tightening. If they stop tightening, you're going to have a huge rally in treasuries, and the dollar will go the other way. And by the way, gold will do spectacularly well. And I think that's going to happen this summer. I think this summer the Fed is going to go on hold. People stare at me like I'm insane when I say that. But I said, you're talking about Powell, the pivoter. He told us in December of 2018, I'm not stopping at 2.5. He said, I got to go above 3%. And he got stopped out at 2.5. Next thing you know, he's actually cutting rates in 2019. But of course, inflation was 2%, not 8%. They're not easing policy anytime soon, okay? But all they have to do at this stage to generate a rally in treasuries based on what's priced in. Remember, you have a 3% funds rate priced in. What if they stop at 2%? The treasury yield market will adjust. And by the way, because of the inverse relationship between yields and gold will do extremely well in that environment. Be patient. This is only a few months away. If this call is prescient, it's going to be coming this summer.
Final question, David. We've had several guests tell us that the beginning of a massive new commodity super cycle, bullish commodity cycle, is just beginning. Sounds like from what you've just said, you might think it's already over, or commodities have already peaked. Is that right?
You know, last time I heard all that rhetoric was in 2008. And back then it wasn't about greening the world. It was about Chinese voracious demand for commodities and their double-digit growth. Global decoupling, and all that nonsense. I think you could argue that the commodities that will play a role in the greening of the world have a secular tailwind. But commodities are also cyclical. I get nervous when people talk about the super cycle in commodities because it's usually signs of a market top. It reminds me of when Robert Toll of Toll Brothers back in 2006 on CNBC told the anchors that housing was no longer cyclical, that there was a new paradigm in housing. I'm not an advocate of new paradigms or new eras. I don't believe in those. Those are fairy tales. I do think that there are a lot of reasons why you want to be bullish on LNG in North America. I think there's lots of reasons why you'd want to be bullish on uranium. As Europe, look, this is all about a fundamental story that we know is going to happen, which is how Europe diversifies its energy uses away from Russia. So there are areas, like I said before, LNGs, I'd say pipelines, I'd say uranium, obviously. France is going to be really the poster child for how Germany is going to have to respond through nuclear, God forbid. But, you know, that's going to happen. And then you have the reality that the world over time is going to move towards electric vehicles and the impact that's going to have on a whole array of materials that are in shortages. And so I do believe that, notwithstanding, you know, the bullish rhetoric on the new paradigm in commodities and the super cycle, that there are commodities out there that have strong supply side characteristics. But we have to also remember that there are commodities that also have that they do have cyclical characteristics as well. And you typically don't want to be long the commodity basket, say the CRB or the Bloomberg Commodity Index or the Goldman Sachs Commodity Index into a recession. You could be bullish on oil, and I could understand that over the next several years. But, you know, if we have the recession that I think we're going to have, I'm not saying oil is going to $50, but I could see oil going back to $75, $80, which is just fine. It just means that as an investment, it's going to correct from where it is today. So we're trying to just discern here between the, you know, short-term cyclical characteristics. And when I say short-term cyclical, that's a year against what could be a 5-10 year horizon.
David, I'm going to only push back on one thing, which is when you say that there are no paradigm shifts, I can cite one, which is for decades, your Breakfast with Dave newsletter was already legendary on the street. But let's face it, by your own admission, for a lot of those years, you were under pressure from your employers to say what they wanted you to say. There is, I would say, a new paradigm, which is for the last couple of years, Rosenberg Research is not under pressure from anybody. Has that changed how liberal you can be with the truth? truth in Breakfast with Dave? And for anybody, I can't imagine anyone not familiar with it, how could they find out more, and is it possible to get a trial subscription?
Yes, absolutely. So in answer to your question, I started the business. Look, I think anytime you work at a company and you're on the sell side or the buy side, you're going to be under pressure to always have a positive story to spin. I did my best to resist that. I never published anything. Quite often, I would just pull the piece if I felt it was just changed too much. So you've got to maintain your self-respect, and you've got to also maintain your due diligence and your responsibility to your clients to always tell the truth. And so, yeah, it's running my own firm has been a godsend in that respect, because I don't worry about hurting people's feelings. It's not, you should take our views on the financial markets like it's religion. It's just a view based on homework, and people will come to different conclusions. But if I come to a conclusion that is not bullish, I like to go ahead with it without it having to be cleansed. That's a really great feeling. So, yeah, and I'd say that people who have followed my work for decades, never mind back to Gluskin Sheff and Merrill Lynch, back to the old days of the Bank of Montreal and Scotia in the 80s, people who followed me for 30 years have told me that the stuff that I'm pumping out today is the best it's ever been. And that means a lot to me when you consider the team I especially had at Merrill Lynch, which was in the top 3 ranked for 5 consecutive years. So in terms of getting in touch with me, I would just encourage everybody just to Google Rosenberg Research. You can go on the website, and there's a function that you can get the free 1-month trial, and kick our buckets for a full month. You get everything that we do: the dailies, the weeklies, the monthlies, the webcasts, the special reports. And that's how we like to do business, is we want people to know exactly what it is what the experience is for a month before they become a client of ours. And we have annual subscriptions. You can buy the premium package at a huge discount, but we have an a la carte as well, that you can buy individual products as you see fit, what fits into your budget. Short of that, feel free to call me at any time, 647-802-4146, or go on the website, Rosenberg Research. Just Google the words and it'll take you right there. And but if you do want to call me, be happy to chat with you.
David, I can't thank you enough for a terrific interview. Patrick Ceresna and I will be back right after this. After being sold out of advertising space for a couple of years now, we do finally have some capacity to add another advertiser. If your company is interested in advertising on MacroVoices in the spot where I'm speaking right now, send us an email at sponsorship@macrovoices.com. Meanwhile, let's get right back to the show.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it's great to have Rosie on. One of the interesting things is that you're right, he was on the show, 3-4 months ago, and he was showing some of the warning signs that was out there in the markets, and, certainly coming to fruition. So it's interesting to get him back to get his update. What did you take away from the interview?
Well, as our regular listeners know, I have been saying for more than a month now, I don't understand why the S&P is above 3,000, never mind 4,000. Well, it's not above 4,000 anymore. I didn't really have any analysis that went into picking the number 3,000. It was kind of off the top of my head. I found it refreshing to hear Rosie's number is 3,100. I'm sure he's probably done more careful analysis than I have, so I'll revise my number based on Rosie's influence. 3,000 is my target now. I'll stick with 3,100, his low number. Again, if it turns out that inflation is totally under control and the Fed is not really going to be constrained by the need to fight inflation, and the Fed put can kick back in, that would change everything. But I don't see it happening at this point. I think the key right now, though, Patrick, is I'm looking at about 3870 on the S&P and falling rapidly as we're recording early on Thursday afternoon. I think it's time to talk about we're already technically oversold. That doesn't mean this bear market's over, but it means we're over due for a bounce. So when does the short-term bounce start? That is the title of Patrick's chart deck. Listeners, you find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Patrick, let's hit it. Page 2. You had the red line in the sand, which you showed us last week, and sure enough, we've broken decisively below it this week. What comes next?
Well, it was 2 weeks ago, but we did have that chart up. And what is interesting is that we talked about the importance of that support line. Essentially, the market had a very typical correction at that moment that was characteristic of what we've seen in the past. And we were highlighting that if it's sort of like an edge of a cliff, and if the market was going to fall off the edge, it had a whole nother level to go down, and that's clearly what has come to fruition. Thing is that we've now reached some pretty oversold conditions in the market, and while I do believe that you and Rosie have merit to your views that something bigger is underway, and that much lower levels in the S&P could come later this year, the reality is these types of bear markets rarely happen in one fluid motion. I mean, we did see that back in March 2020, where it was just one crash to the downside. But often bear markets have big bear market rallies and then sell off all over again. Like you think back to the 2008 to 2009 bear market that lasted like 18 months. There were multiple periods where the markets had declines with huge rallies. And so without saying that the bear market is over and that, in fact, the selling can continue later this year, we're getting oversold enough that a tradable short-term low can emerge. And so the bigger question is what levels does that happen, and where do we go from here? Like that targets of 3,500, what we were highlighting about the 50% retracement of the rally, I think is all in line. And if we did have a short-term liquidity event, wiping out an extra 300-400 S&P points here on the downside in a couple of days would be very typical of that kind of final short-term capitulation of a downswing. And it could happen, but the one thing, if we look on page 3, where I have the oversold condition of this market, now that we gave out that 25 support line, we're now almost as oversold as we were during the March 2020 sell-off from a market breadth perspective. There's still room for it to go down, and hence why I think it might be premature to already say that today is going to be the low. But what I would say is that while lower is the path of least resistance, and certainly can be a violent drop to the downside, I think that we may be, from a calendar perspective, even within a week, see some sort of a tradable bounce. And considering that we have the option expiration next week, where dealers get jammed up with all sorts of gamma, a huge volatility next week, both down and up, is a very realistic possibility.
Going back to page 2, Patrick, that's a pretty darn solid support line that existed there just above 4,100, it looks like. Once we've broken down below that and we get a bounce, do you think that that same level is going to become resistance and that's going to cap the bounce, or would you see a bounce going well above that red line?
Well, if the bounce started today, then no, it will go above there. But if we got all the way down to like 3,600, then that would it would take a 400 or 500 point rally higher on the reaction to get above there. So I think that to make that call, we'd have to see first where the bounce begins. And right now, we know that the sell-off is not yet over. At least at the time of this recording, the downtrend is still quite intact, and new lows are still being made. And so before I make that kind of a call, we'd have to definitely see where the final kind of capitulation short-term low comes in.
Let's take a look at the volatility index on page 4. What's that chart telling us?
Well, the interesting part is that while volatility has returned to the levels we saw in March, we haven't yet seen that kind of explosive volatility that is associated with a crash. Like I intentionally captured the 2020 event here, where we had the VIX shooting up to the 80, 90 level on the upside on an intraday basis. And while this, like you were saying, the selling is occurring, we aren't really crashing. And that's actually the difference of this scenario. This is a methodical bleed more than it is a crash. And that really, to me, can be looked at two ways. One, we're not going to crash in this iteration of the sell-off, and that this overhead resistance at around 35.40 on the VIX will house the short-term swing high of this swing down on the market. Or the other question is, what if this thing does just accelerate and start to crash and we finally have a breakout above that VIX? Obviously, predicting a market crash is always a low probability event. Like on balance, the markets tend to bounce much more often than tend to crash. And so you can't assign a high probability of it, but it is a very vulnerable moment. And considering the weakness and the poor sentiment, there's a lot of things to be nervous about.
Patrick, I want to pick up your point about a methodical bleed of equity prices without a crash. Now, what that says to me is human emotion hasn't gone out of control yet. It seems to me like this is institutional reaction to changing monetary policy, the recognition that inflation is likely to constrain the Fed's ability to fight inflation and so forth. That means that institutional traders are doing their institutional thing, which is not panicking, but just accepting prices going down and continuing to sell into them in a slow and methodical pace. What happens when retail freaks out and all of the people who were convinced that stock prices can only go up suddenly panic? It seems to me like that moment hasn't come yet. I can't think of a reason that it wouldn't come unless we get a complete bottoming and reversal pretty darn soon here.
Erik, it's certainly a very interesting moment in the markets, and your point is made. I mean, really, the one thing that I think we have to just leave it at is the fact that the prevailing downtrend is still currently dominant, and we have to respect that. And really, now that we've given out supports, there really is this air pocket of space where all sorts of scary, volatile things can happen in both directions. By the way, it doesn't have to just be all down. Well, I think the best way to leave it is that all of our listeners need to strap on the seatbelts, because the day in, day out volatility is only going to be more and more intense at this stage.
I couldn't agree more, Patrick. And again, we haven't seen panic yet. What you're seeing now is a methodical sell-off. Let's move on to the dollar index on page 5. I said before I wasn't sure whether it was a 20-year high. It looks like it's maybe a 19-year high as I look back on your chart, which goes back further than mine does. What do we make of this, and how long, considering it's been 20 years, how long do we need to stay above that line in order to confirm this breakout, which would tell us that there's quite a bit higher to go still?
Well, I mean, that's subjective. This is a monthly chart, so I guess if you were utilizing a monthly chart basis, you would at least want to see the monthly close happen above that level. But I don't think that alone is it. To me, it's going to be about the price action itself. The reality is that the yen has not participated in this, but the euro made the big breakdown. And with the euro and the pound sterling so weak, if the euro here was heading down to parity, and we see this kind of weakness persist, then this dollar uptrend is certainly going to be confirmed. And considering the dollar index is weighted so heavily to the euro, this is really going to be about a call of whether the euro is destined for a trip below parity. And that's a bigger question I think I want to analyze over the coming weeks. It's certainly not one I'm ready to stick my neck out on today. With that said, Erik, let's talk oil. And you were absolutely right in the market wrap when I was saying that, it's certainly not lacking volatility, but it's lacking directional volatility. We've more or less stayed within the same range for 2 entire months. And while it's been a pretty wide range, the ping pong match from support to resistance is persistent here. And the one thing, though, is that in this kind of huge risk asset deflation cycle we're seeing where almost nothing is safe in the commodity markets and nothing is safe in the equity markets, crude oil is really not. It has been able to hold up relatively well. And I asked the question there is that, well, if once we see some sort of a short-term tradable low, does that mean oil leads the way out of it on the upside? It's a really interesting question that we're going to be watching technically to see if that emerges.
My prediction, Patrick, is volatility will increase for sure here. And in terms of direction, I think ultimately it resolves higher. But boy, there's plenty of room. If we see that emotion come into the stock market and we get an outright crash and everybody finally wakes up at the same time together and says, oh my gosh, it really is a recession coming, which I think has been clear for a long time now. When everybody figures that out, there's lots of room for, I'll call it old school wisdom to say, oh, if there's a recession coming, oil prices have to go down dramatically, 10 or 20 bucks. Lots and lots of speculative longs will liquidate their positions, believing that it's a certainty that recessions have to cause oil prices to go down dramatically. I don't think that those people will be considering that it could be the market is seeing that higher oil prices are coming, and that might be one of the reasons for the recession to begin after all, because the cost of energy is going to have a defeating effect on the economy. And if you look at what's going on in terms of policy by the U.S. government, as well as the escalating conflict between the superpowers, I think there's lots of room for an upside resolution well above the 130 high or 131, whatever it was that we set that Sunday night right after the war broke out in Russia and Ukraine.
Erik, just on page 7, I had that copper chart, and I really just wanted to reference that as a point to that oil chart, which is the entire commodity complex has been distributing, and it was really oil has been holding up. And whether you're talking iron ore, the basic material names, the uranium names, there's nothing safe right now. And copper here is now trading down to a multi-year low at the bottom of that consolidation. It'll be technically really interesting to see whether copper can actually bottom and base along that level. But Erik, what I wanted to though move on to and talk about is bonds. And so just as a reference point, I wanted to on page 8 show the bounce in the 10-year Treasury note as that 3% yield that we're back down below it on the 10-year yields. But what I wanted to really reference that to is looking at the high yield bond junk ETF on page 9, which continues to get hammered lower and has not reacted as Treasury bonds have bounced. And so what that usually reflects is, like on page 10, that the credit spreads are starting to widen. And this was one of the things that me and you talked about over the last 3-4 months, talking about when will we start seeing the cracks in the corporates, and whether investment grade or in junk or high yield, these high yield markets, when will it start to reflect that these companies are bigger credit risks and need a premium there? And we're finally seeing that, and I think that's being reflected in the stock markets here.
Patrick, this chart jumped off the page when I saw it in the deck, and the reason is, as our long-term listeners know, how many times did we predict or analyze and say, boy, the junk bonds are so overvalued, they have to eventually crash, and we tried to make that call, and we were just way early and got it wrong and ended up having to cover our shorts at a loss. Well, okay, the big sell-off in junk that we predicted several years too early seems to finally be happening. I doubt that it's over yet. And remember, junk spreads used to be like 10 or 12%, like 1,000 to 1,200 basis points above Treasury yields back in the good old days before everybody decided that low interest rates pertain to everything, including credit that's not likely to be paid back. It seems like that's changing, and the price of junk is coming back down to earth. If this continues, I think it's a really strong sign. Listeners, if you enjoy Patrick's chart decks, I know I sure do, you can get them every single day of the week with a free trial of Big Picture Trading. Get the information on page 11 and 12 of the chart deck, or just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by farmtogether.com. Diversify your portfolio with U.S. farmland, one of the most inflation-protected and recession-resilient asset classes in the world, now available to all accredited investors. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed here in the postgame. There's also a link to a number of articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. For those of our listeners that blog or write about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow me on Twitter at Patrick Ceresna. On behalf of Erik, Townsend, and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.